So it's been a month since the last one of these videos that I've made, but I'm talking about the UK stocks that I'm buying right now. Now, obviously, in my portfolio, it's a very limited, small selection of hand-picked stocks, so obviously not much is going to change overall. However, I think the strategy itself is always adapting and changing. For instance, if we go back, obviously, 2-3 months ago, I was always depositing regular intervals of money because previously I used to be paid on a weekly basis. Now that I'm paid on a monthly basis, I found it's a lot easier to have a hands-off approach. This means effectively the moment I get paid that salary and the money that I therefore save and invest immediately gets transferred out of my current account and straight to my investment pot. And then on that next working day when the stock market is open, I will then purchase the shares that I'm interested in on that given time. This saves a lot of hassle because, oh no, the stock's up, they're down. It doesn't bother me because quite frankly, I'm not looking. And it's a fantastic way really of really being able to focus on other areas of life, in my opinion, and really not get bogged down with, oh, my stocks are doing mediocre or whatever like that. Not that I'm someone that's really prone to that, but I can certainly see a lot of emotion in the comments as well. Now, a lot of you, and I can understand it, but you will just go, oh, you know what, look, you're really arrogant, you just don't do the work, you don't know what you're doing, you're down 50%, just quit. And quite frankly, it's a load of rubbish. It's a bit ridiculous to say that because I can come off as arrogant, but I know exactly what I want to achieve. I could say right now that I'd want to be one of the best investors, not by fame, but in terms of skill level and being able to get a good long-term return, hence why I'm individually picking stocks. Now, that's because I'm willing to put the work in. I'm doing the work right now. Whereas you might go, well, actually, no, you're just telling people on YouTube. Well, no shit, Sherlock. Telling people on YouTube is another form of revenue for me. So it's an easier way of keeping the income going as well as being able to keep an eye on my investment strategy itself. So you might go, well, that's really arrogant. You can't expect to be better than the greats. Well, you'll never know if you can become better than the greats if you don't try. Now, that said, I'm not here for notoriety. I'm not here for fame. I don't care. Like, if I was making 40% a year, to be honest, I'd rather not be famous about it. I'd rather just be quietly making 40% a year in gains. Now, someone's going to call me out on that and go, 40% a year? How unrealistic, child. Stop that. And it's a load of fucking rubbish, like, because really, I'm not actually after 40% a year, but I would like to outperform the markets by a certain margin. And I think my long-term goal really is to double the average annual rate of the markets. So I'm looking at about 16%. That's the goal. I mean, obviously, if we look at my portfolio at the moment, that's the wrong one. We can see that actually, yeah, I'm down 45, nearly 46%. Right, which is a high amount, and it's because I had a rocky start in the last 2.5 years. That's fine, I accept that, but I continue to learn from it. What have I learned from the last time? Well, valuations. I didn't put that much effort into it, and also I was very keen to buy very early, whereas I should have been more patient, more disciplined, like I am now, just buying in regular intervals and not stressing myself out too much. Furthermore, back then I was in such a hurry, such a rush to deposit more money in, and therefore obviously buy more stocks, that I was absolutely depleting my savings outside of the portfolio, which is something I don't do anymore. I have a lot of cash outside of the portfolio now, which means I'm a lot more resistant, and it means overall I'm more agile. If something goes wrong in the stock market, well, I can put some more money in, or I'm just going to keep making money with my workplace, my income streams, and I'll just reinvest that where possible. That's really the typical plan of what I'm going through at the moment. That said, I have been buying more shares. So this week, I've actually bought about 790 more shares of Boohoo stock. Now, this is obviously my primary position in the portfolio, and considering I'm down 51%, I was down 60% at one point in time. I'm really bringing that average down. Now, if we go back about 7 or 8 months now, if we go back to December 2021, my average price, I believe, on Boohoo was about £2.17. I've gone down by a third of the price. That is a fantastic drop right there. And to be fair, I could be going for the halfway point. I think that would be a very remarkable figure to reach. And so long as the share price is below my average, and I believe there's long-term value, I'd be a fool not to continue buying it. But a lot of you go, okay, well, why are you keeping your eggs in one basket? Like, why not diversify? Because diversification is protection against ignorance. If I'm going to be ignorant, I want to learn as much as possible from it. If I've got 20 different stocks, I'm not going to follow it well, and I'm not going to learn the lessons that are very critical. Oh well, so fucking what? If I lose all of my money in Boohoo, That's fine, but the value, the lesson, and what I would have learned from that would exceed the value of monetary levels of what's in the investment portfolio. That is irrelevant. It doesn't matter how much is in the portfolio, because quite frankly, I'll learn that for the future. And if anything, it's a fantastic motivating tool to go, okay, you know what, look, you've almost lost it all. Now you've got to work even harder, push even harder, like do even more work to achieve and resave up that money. That will motivate you to be making more money, become more efficient at what you do effectively, and really delivering more value. And I think overall, that's a great position to be in, that position of constant pressure. Like, for instance, why a majority of millionaires that are currently around are self-made, and they likely come from obviously the lower classes, for example. These people don't obviously know what it's like to be poor, and therefore they don't want to go back there, so they don't want to live on the breadline, so they do the work, they put the hours in. Whereas you get these rich parents with these rich kids, and these kids sit on their asses doing absolutely nothing, and it's quite depressing. Like, what are they actually doing with their lives? Nothing. They're on TikTok scrolling all day and complaining about their depression. Like, no one cares. But the point I digress from, the point really is here that it's a great motivating tool. I mean, don't get me wrong, if I lost my entire position in Boohoo, I've fundamentally screwed up. That's fair enough, which I don't for any moment believe that will happen. But in that event, at least I can say, you know what, it's a valuable learning lesson. That said, it could also be seen as a buffer. Now, I don't mean the buffer solution in chemistry. That's not quite what I mean. But what it could be is a way of mentally basically saying, oh, well, if I lose it, well, at least I prepared for that. Mentally preparing yourself. And in that situation, I get it, right? If you're too concerned of selling your stock, if the story changes, then obviously you're going to fool yourself into this and you're going to ride it all the way down to the bottom. Now, despite what I've just said, it doesn't necessarily mean I'm going to ride down to the bottom. If I believe that the company is genuinely delivering long-term value and increasing their overall revenue, and I think they're going to continue growing, then it is a no-brainer for me to continue averaging down. And we've seen recently the shares of Boohoo and Games Workshop and a lot of the growth stocks in the markets at the moment have actually been forming bases. And these bases seem to be the low point as far as I'm aware, at least in the last few months. And it seems like from now, as you see the indices slowly move and be a little bit more stagnant, we're seeing these growth stocks really roar ahead. And that is where I think there's a lot of promise here, because the growth stocks previously dipped much earlier than the indices. The indices were still holding up at all-time highs for a very long time, and the growth stocks were already down 40-50%. So now this could be a fantastic time to perhaps rotate out value stocks and buy a little bit more growth stocks. I mean, in my portfolio, I only hold growth stocks, with the exception of Games Workshop, which is definitely a growth stock. They've had some good results very recently, and I bought 3 more shares. They've declared a dividend, though, of 90 pence per share, which is the highest they've done so far. In fact, if I quickly show you this on my screen, so we can see that now, Games Workshop, you can see this, right? Q1, they've declared a 90 pence dividend. Now, they don't necessarily pay for quarterly dividends. It's just truly when they have excess capital or cash, which they want to divest to shareholders. Now, I get it. A lot of businesses could reinvest that back in themselves and generate significant shareholder value that is more tax efficient and better for the shareholder than the form of a dividend. But I also like the management's perspective on things like this, and they do truly, basically they identify what is the best thing they could do, and they have actually got a statement in their annual report, which I'm not going to be able to pull off out of nowhere. And they're pretty much talking how they don't like the idea of long-term incentive plans. Perhaps I can find it. Let's have a quick look. So they don't like long-term incentive plans, because effectively what it's doing is it's not really helping. All it's doing is giving them all a bigger salary, which doesn't necessarily align with the shareholders, which obviously could be a concern here. Now, yes, so they say the remuneration committee notes that our policy will never fully address a shortfall in total remuneration compared to a majority of FTSE peers, because neither the committee nor the executives themselves believe that LTIPs, or long-term incentive plans, are in line with Games Workshop's culture and values. Now, that is critical, and that is one of those things where you can see a fantastic management themselves. So obviously I have been buying 3 more shares of that. I think it's wise now that, especially as I was buying purely Boohoo for quite some time, that I can really take the time and just merge between it and put a bit more in Games Workshop, a bit more in Boohoo. Games Workshop at the moment is holding up a lot stronger, and they've certainly had some impressive results which they've released in their annual report. I've not had the time to read much, if at all, any of this at the moment, but you can see from the actual figures themselves that their revenue is increasing, albeit the licensing revenue is pushing up a lot of their earnings, but overall they've got a greater level of earnings per share, and that's what, an 8% increase I think at the moment, which isn't ground-taking or breathtaking in terms of an increase, but it's certainly not a bad hit when you consider the fact there's a lot of supply chain disruption in the markets at the moment. And then we've also got the likes of ASOS and Boohoo being targeted by a greenwashing probe. The CMA, or the Competition and Markets Authority, has opened a probe into potentially misleading environmental claims by online fashion retailers. Now, I don't think this is a concern whatsoever, because Boohoo was kind of called out on this 2 years ago in July 2020, in which pretty much they've now had to really review their supply chain, and obviously they're going to be in a much stronger position to cooperate with this, and they're going to be like, well, this is what we're doing, this is now something we care about, this is what we can focus, and overall it looks good for Boohoo if they engage very well with the CMA, or the Competition and Markets Authority, and it will really reboost investor sentiment over time, which is exactly what we're seeing at the moment. The fundamentals have kind of deteriorated over the last year and a half, but we're seeing investor sentiment start to rally strength in these shares, hence why we're seeing it push up quite a bit at the moment. Thank you for watching. Have a fantastic day.